Everyone, if you've been checking the stock market lately, you probably noticed some wild swings. Prices are going up and down faster than ever. And honestly, in investment, it can be terrifying if you don't know how to handle it. Today, I want to break down exactly what's happening, why it matters to you, and what you can do to protect yourself and even find opportunities in this chaos. Investment, by the end of this, you'll have a clear action plan so you're not panicking when the market throws a curveball. The first thing every investor needs to understand is market volatility. Volatility is essentially the speed and intensity with which stock price rise and fall over short periods. Right now, the market is experiencing heightened swings driven by multiple factors, interest rate changes, uncertainty, global political tensions, inflation concerns, and large institutional moves. When these forces converge, it creates sudden, sometimes dramatic, market fluctuations that can feel overwhelming, especially to newer investors. It's important to realize that volatility is abnormal and, in many ways, a sign of a healthy market. Price swings are a natural response to new information as investors adjust their expectations for future growth and profits. What often feels like chaos is simply the market finding a new equilibrium. For long-term investors, short-term drops are rarely catastrophic. They are part of the journey. Historical trends show that markets typically recover from downturns, and patient investors who stick to solid fundamentally strong investments often come out ahead. The key is separating emotion from decision making. Fear can make investors sell at the worst possible moment, locking in losses rather than letting the market stabilize. Conversely, understanding the reasons behind market swings allows you to make rational, informed decisions. Look at earnings reports, economic indicators, investment, and sector-specific trends instead of reacting to headlines. Knowledge acts as a buffer against panic, helping you see volatility as an opportunity rather than a threat. In short, volatility should not intimidate you. It should educate you. By recognizing that short-term noise does not define long-term outcomes, you can approach the market with calm and confidence. Every fluctuation is a learning moment, and over time, understanding these patterns equips you to navigate the ups and downs with a steady hand and a strategy built for success. Once you understand market volatility, investment, the next step is mastering risk management. Risk management is all about protecting your investment so that market swings don't derail your financial goals. Investment. One of the most effective ways to do this is through diversification. By spreading your investments across different sectors, industries, and asset classes, you reduce the impact of any single stock or market segment underperforming. For example, if tech stocks drop, having holdings in healthcare, consumer staples, investment, or energy can help balance your portfolio and prevent major losses. Another key element is position sizing. This simply means you allocate a proportion of your portfolio to each investment based on your risk tolerance. You should never invest more in a single stock than you're willing to lose, especially in volatile markets. Smaller, calculated positions help you stay calm during sudden drops. Investment. Allowing rational decision making instead of emotional reactions. Stop loss orders are another practical tool. These orders automatically sell a stock when it hits a predetermined price, protecting you from extreme losses during rapid declines. While they aren't foolproof, they offer a safety net, especially for investors who can't constantly monitor the market. Maintaining a cash reserve is equally important. Having liquidity gives you flexibility. You're not forced to sell investments at a loss during panic. You may even have money available to take advantage of buying opportunities when prices drop. Ultimately, risk management is about staying in the game for the long term. It's not just about preventing losses. Investment. It's about positioning yourself to capitalize on growth when the market stabilizes. By diversifying, sizing positions wisely, using protective tools, and keeping cash on hand, you build resilience. This approach allows you to navigate chaos confidently, avoid emotional mistakes, and maintain steady progress toward your financial goals, no matter what the market throws at you. One of the most overlooked aspects of a chaotic market is that it often creates opportunities for investors who know where to look. When fear drives prices down, it often pushes high-quality companies below their intrinsic value. This is where disciplined investors can step in and buy strong businesses at a discount. The key is to focus on Oz fundamentals rather than reacting to panic-driven headlines. Look for companies with healthy balance sheets, consistent earnings, and a competitive edge in their industry. These businesses are more likely to recover quickly and continue growing over the long term. Another powerful strategy is dollar cost averaging. Instead of trying to time the market perfectly, which even seasoned investors struggle with. You invest a fixed amount regularly, regardless of price. When the market falls, your money buys more shares. When it rises, investment, it buys fewer. Over time, this approach smooths out the effects of volatility and often results in better average returns, reducing the stress of trying to predict market moves. Chaotic markets also reveal as undervalued sectors. Certain industries may experience temporary declines due to general market panic, even if their long-term growth remains strong. For example, technology, investment, renewable energy, and healthcare can dip alongside the broader market, offering strategic entry points for patient investors. Having a watch list of these sectors allows you to act quickly when the market overacts. Finally, it's crucial to view market downturns as opportunities, not threats. Fear sells, patience buys. Investors who maintain discipline and a long-term perspective often come out ahead because they capitalize on mistakes made by those reacting emotionally. Chaos is uncomfortable. It is also the breeding ground for wealth building. The investors who recognize this and act strategically during downturns are often the ones who see the biggest gains when stability returns. The most important principle for any investor during chaotic markets is maintaining a long-term mindset. Market fluctuations are inevitable. There will always be economic reports, geopolitical tensions, investment, or interest rate changes that cause sudden swings. While it's natural to feel anxious during these periods, reacting impulsively can be one of the fastest ways to lose money. Instead, investment. Focus on your long-term financial goals, whether it's retirement, building wealth, or achieving financial independence. By keeping your eyes on the bigger picture, you can avoid getting caught up in short-term panic. Discipline is key. Emotional trading, buying and selling based on fear or hype, rarely works in your favor. Investors who succeed over time are those who stick to a consistent strategy, stay informed, and resist the urge to chase quick gains or exit during a downturn. Reviewing your portfolio periodically rather than obsessively helps maintain perspective. And checking your investments quarterly or semi-annually allows you to stay informed without being influenced by every market headline. Another critical part of a long-term mindset is trusting the power of compounding. Investments need time to grow, and frequent reactions to market chaos can interrupt that growth. By staying invested through volatility, you give your portfolio the opportunity to recover from short-term drops and benefit from long-term upward trends. Education also plays a major role in sustaining confidence. Understanding how markets work, why fluctuations happen, and the historical resilience of investments reduces fear and empowers rational decision-making. Surround yourself with reliable information and avoid sensationalized news that promotes panic. Ultimately, a long-term mindset transforms chaos from a threat into a manageable part of investing. By staying disciplined, focusing on your goals, and letting time work in your favor, you can navigate volatility without stress. This approach not only protects your wealth, but positions you to thrive when the market stabilizes and opportunities emerge. Patience, discipline, and knowledge are your greatest allies in any turbulent market.